Ladies and gentlemen, good day and welcome to the PVR Limited Q4 and FY22 earnings conference call hosted by Axis Capital Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Ankur Periwal from Axis Capital. Thank you, and over to you, sir.
Thank you, Aman. Good evening, friends. Welcome to PVR Limited's Q4 and FY22 post-result earnings conference call. As usual, the call will be initiated with a brief management discussion on the Q4 and full year performance, followed by an interactive Q&A session. Management team will be represented by Mr. Sanjeev Kumar, Joint Managing Director, PVR Limited, Mr. Gautam Datta, CEO, PVR Limited, Mr. Kamal Gyanchandani, Chief of Business Planning and Strategy and CEO, PVR Pictures, and Mr. Nitin Sood, CFO, PVR Limited. Over to you, Mr. Kumar, for the initial comments.
Thank you. Dear all, I would like to welcome you all to the earnings call to discuss the audit results for Q4 12 months FY22. I hope you've had the opportunity to review our presentation and results, which have been uploaded on ours as well as on the stock exchange website. The year gone by hopefully marks the end of disruptions on account of COVID. The third wave of COVID that started in the last week of December 21 was the shortest in duration. The infection positivity rate peaked in mid-Jan 22 and came down drastically by the end of Jan 22. All the states and UTs implemented restrictions around capacity and night curfews, which impacted cinema operations. This time around, except for Delhi and Haryana, no other state mandated complete cinema shutdown. By the end of Jan 22, the state started to withdraw restrictions, and by the end of Feb 22, almost all restrictions had been done away with. As on date, all restrictions have been lifted across more than 99% of the screen portfolio. Release of new blockbuster content, which had started from first week of November, abruptly stopped as soon as fresh restrictions were announced in the end of December. There was no fresh content for the month of January and for a large part of February. Release of blockbuster content resumed from the fourth week of February, namely Valimai, Bhimla Nayak and Gangubai. This was followed by Kashmir Files, which was a sleeper hit, RRR and Batman in March 22. Consistent flow of new content ensured that the admissions in March touched a post-pandemic peak of 90.6 lakhs, an increase of over 38% over December 21 admissions. The company was gearing up for a stellar Q4 when the third wave came upon us swiftly. It was difficult for the company to pare down its fixed costs, primarily because almost all the cinemas are operational, and secondly because we realized that the recovery from this wave would be equally swift. The company witnessed operational losses at the EBITDA level for the month of Jan and Feb, followed by strong profitability for the month of March, with EBITDA margins in excess of 20%. The company opened 29 screens across 5 properties in FY22 and also closed 23 screens across 9 properties on 31st March where leases had expired. A 6-screen multiplex in Rourkela was the first cinema that the company opened in FY23. It marks PVR's foray in the state of Odisha. The company plans to open 120 to 125 screens in FY23. Most of these will become operational in the latter half of the year, and the entire capex will be funded through internal accruals and liquidity available with the company. Our screen portfolio currently stands at 854 screens across 173 cinemas in 74 cities in India and Sri Lanka. On the results, please note that the numbers I'm sharing are after adjusting for the impact of Ind AS 116 relating to lease accounting and are different from the reported numbers which submitted to the stock exchange today. For the quarter ended March 31st, 22, total revenue was 554 crores, EBITDA loss was 18 crores, and PAT loss was 96 crores, as compared to revenues of 191 crores, EBITDA loss of 118 crores, and PAT loss of 272 crores for the quarter ended March 31st, 2021. For the 12-month period ended March 31st, 2022, total revenue was 1,409 crores, EBITDA loss was 155 crores, and PAT loss was 419 crores, as compared to revenue of 310 crores, EBITDA loss of 424 crores, and PAT loss of 666 crores for the 12-month period ended March 31st, 2021. We continue to keep adequate levels of liquidity on the balance sheet with over 667 crores as on March 31st, 2022. A quick update on the proposed merger with Inox Leisure Limited, which was approved by the boards of the two prospective companies on 27th March 2022. The company has filed a draft scheme of amalgamation with BSE and NSE on 30th March 22. Approval from the stock exchanges and SEBI is awaited, post which the scheme will be filed with NCLT. To conclude, I would like to thank all the stakeholders for their unwavering commitment and support to the business. With a strong pipeline of content available for release over the next several months, we are very confident that the business will continue to perform strongly, and 22-23 will be a bounce back year for the cinema industry. With these opening remarks, I open the platform for any Q&As. Thank you very much.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. First question is on the line of Abneesh Roy from Edelweiss. Please go ahead.
Yeah, thanks. My first question is on the recent box office performance, especially in the non-South market. So all the key movies like Heropanti, Jersey, Runaway, 34, etc. Have decent star cast, and also in terms of marketing, they have not really been behind. But still, the revenues have been well below expectation. And in the past, we have seen that when a slew of flops are there, then consumer would like to wait, and the behavior becomes of more of wait and watch rather than rushing to watch movies. So do you see that risk? I understand every week we have a few movies releasing because of the pent-up lineup, but still so much of back-to-back disappointments, is that a concern?
Kamal, would you like to take that?
Sure. Abneesh, thanks for the question. Before Heropanti, Runway 34, Attack, we also had Kashmir Files, which performed beyond the wildest expectations. I mean, even the most optimistic expectations were beaten by a huge margin. It is one of those classic sleeper blockbusters, and it's a film in Hindi. And Gangubai, this whole season of getting audiences back to the big screen started with Gangubai, and that was, released in February, but fairly close to April period, just right at the beginning of the movie season. And again there, although it was led by a female actress, but because the director is popular, well-known, it was able to attract people. And again, the film exceeded the expectations. You would have normally expected 70-80 crores sort of a net box office. The film went on to do almost close to 155-160 crore. So our business is of peaks and valleys. There would always be surprises. There would always be films which will surprise us on the negative side, on the downside. And then there would be films which will beat our expectations, most optimistic expectations, and surprise us on the upside. That's the nature of our business. No one thought KGF will turn out to be the second biggest Hindi film all time after Bahubali 2. Kannada films as a regional language has never even been in the reckoning. It's always been Tamil or Telugu, and Telugu more so because of Bahubali and Mr. Rajmouli. But no one thought Kannada films would be able to beat all other regional languages, and the film dubbed in Hindi will turn out to be the second largest, highest collecting box office ever. So that's the nature of our business. I think the good news is that people are back in cinemas in a big way. I would spin this argument, and give you, another perspective that if a dub film with, a somewhat unknown star can do 400 crore plus box office in Hindi dub, and I'm talking only Hindi. I'm excluding all other languages, Kannada, Telugu, Tamil, Malayalam. Then you can imagine when a Hindi film which is rooted in Indian ethos, which tells a story which resonates with a large number of people and which has a popular face at the helm. It could be Brahmastra, it could be Lal Singh Chadda, it could be any other film which is coming. It could very well be Prithviraj. So you can imagine what is the potential of a Hindi film which resonates with a large number of people and which has a popular face. I think the business has the whole perception that we had that this is the maximum ceiling. All of those perceptions and myths have been broken. And what we are seeing in April and before that in March, these are very positive developments.
So just one very small follow-up there. So you mentioned Gangubai, Kashmir Files and the dubbed movies of South India. Those are differentiated content or say more of masala movies. So essentially movies which are not doing well say in Hindi, those are more of a metro kind of audience. So do you see now producers addressing that bit, because clearly mass masala, those kind of movies seem to be working rather than too much of a SEC A1 kind of a content. So would you agree to that, and would you see content getting addressed? I understand some movies are coming which will be more of Indian ethos, but do you see that as key reason why some of these movies did not work?
So Gangubai is not a masala film. It's your SEC A+. It's what you call typically a multiplex film. Batman dubbed in Hindi is targeting multiplex premium audience. Doctor Strange, which has turned out to be the second highest weekend after Spider-Man since we've reopened theaters, is a premium audience, premium segment film. And Doctor Strange is not just done well in the original version, but the Hindi dub is also done exceedingly well. So we've had examples on both sides. I think where you're right in saying what you're saying is that the results are polarized. Films which are doing well are doing exceedingly well. Films which are struggling at the box office are struggling more than expected. But look, we've been off and on, we've been half shut, half open for the last 2.5 years. There would always be some unpredictability in terms of content that people like and would like to come out and watch it in theaters. But I think it's a matter of time when it will settle down. Right now, all sorts of films are doing well. We don't have this concern that only, these pot boilers, commercial films, over-the-top fight films, as we call them, are doing well. That's not the concern at all. In fact, we see that as a positive.
Sure. My last question is on Sri Lanka. So 8.7 crore forex impact. So my question is, what would be your expansion plans in Sri Lanka next 2 years? And in the FY23 period, how do you see the high inflation and lack of low electricity? Those 2-3 issues are there in Sri Lanka market. So how do you see the profitability in Sri Lanka in FY23 given the current context?
Nitin, you want to take this?
Do you want me to take that?
Sure.
Okay. I think as far as this year is concerned, we'll wait and watch. Let's see what happens both with the economy and where the economy is headed. We obviously hope that things get better and improve. The months that we were fully operational, we did very well. We had over 20% EBITDA margin. We've got a lot of support from the developer there, which is a Far Eastern group called Shangri-La. So we're getting a lot of support and, SOPs from their developers. They're very understanding, both with respect to the pandemic and now what's going on with the economy. So we're just waiting and watching. Let's hope that things get better in the next 6 to 8 months and the business bounces back. And as of now, we're just focusing on this one property and seeing where things go and not looking at any expansion yet.
Okay. Thanks. That's all from my side. Thank you.
Thank you. The next question is from the line of Aaron Armstrong from Ashmore Group. Please go ahead.
Hi, thank you for taking my questions. 3 questions from me, please. Firstly, in terms
Aaron,
of ticket pricing.
Can I request you please be a little louder, please? It's not very clear.
Sure, 1 second.
The voice is not very clear.
Yeah, maybe you
The voice is not very clear.
So firstly, in terms of ticket pricing, the trends were very strong last quarter. Could you talk about the outlook for that for the coming quarters, please, whether it can remain at these elevated levels? Secondly, in terms of on the rental side, we've had some anecdotal reports of mall operators looking to catch up some of the revenue that they lost during lockdown. And if you could give any comments on that side of things, please, in terms of whether you'll be paying any kind of catch-up elevated revenue to landlords. And then thirdly, any kind of timing you can give around merger completion and the approvals that we're still waiting for, how long you think that could take?
I'll take the ATP answer first. Technically, we've been out of business for over 2 years, and so whatever growth we have taken on ATP is largely on account of inflationary cost at all ends going up. And now that we've been operating at whatever rate, we intend not to take any pricing up. This is largely going to remain where it is, and we are wanting to maximize footfalls as we go further. And there's a complete acceptance as far as the new ATP norms are concerned, and technically no plans to take the ATP up, and it will remain at the same level. But we are very confident that we'll be able to maximize footfalls with this strategy going forward.
Aaron, on your second question about the rental catch-up, all our deals, bulk of our deals, I would say 98 to 99% of our deals had limited time period long-term discounts available to us during this 2-year period of pandemic. There is no catch-up on rentals with most of our landlords going forward. There could be 1 or 2 exceptional cases where we may have some bit of a higher revenue share during the next 12-month period. But I would say 97-98% of the cases there is no rental catch-up, and effectively we are going to pay fully contracted rentals in accordance with our contract now, which we've also done in the month of March as we came back to full operations. Last question was on merger and timeline. I think that we can only share indicative broad timelines because part of it is not in our control. But just to explain, we filed the scheme post the announcement with the stock exchanges for approval on 30th of March. This process normally takes anywhere between 2 to 3 months before you get approval from stock exchanges and SEBI. Post that, you file the scheme with the National Company Law Tribunal, which I understand the processes could be 6 to 8 months. We think that we should be able to manage the whole process indicatively in a 9-month window as things stand. So, hopefully, in beginning of Q4, we should hopefully see the merger, all formalities being completed. That's the indicative timeline that we are looking at, that, end of December or sometime in Q4, hopefully we should be able to complete all the legal formalities with respect to the merger.
That's great. Thank you. Could I ask maybe one follow-up, please, just on the merger timeline? So the process of the merger not requiring certain approvals because the two companies now fall below the minimum revenue threshold due to the pandemic lockdown. Do you think that that's something that the regulator will view favorably, and in which case you have a very high level of confidence that this will be approved in the 9-month window? Or do you think there could be some ambiguity, there could be some pushback from the regulator, and in which case it could take more time, or there could be a small probability that the merger doesn't go through?
Yeah, see, it's, to be honest, it's quite hypothetical. You know, when we announced it, the scheme, we said, based on the advice that we received from councils, we don't believe that this requires any competition regulator approval, based on the thresholds that we have. And, you know, if we hear anything from the regulator, we'll adequately respond to them. So it's slightly difficult to comment, you know, right now. We haven't heard anything as yet from the regulator, if any, and if we do hear back, we would respond to that. And yes, in that case, the timelines could be affected, but it's quite hypothetical at this stage for us to, you know, comment.
Understood. Thank you very much.
Thank you. Next question is on the line of Prateek Poddar from Nippon India Mutual Fund. Please go ahead.
Yeah, hi. So just two questions. One is just to get some clarification. The 20% margins which you called out for in the month of March, they were pre-Ind AS, right?
Yes.
Okay. And given that these are pre-Ind AS margins, I'm assuming that the ad spend recovery in the month of March would have been very good versus pre-COVID. That's a fair understanding? And also, if you can comment on the forward outlook for that.
No, so ad spend recovery in the month of March was not even 50% of pre-COVID.
It was around 40% of pre-COVID, and it would take another a quarter at least for us to get back within the pre-COVID numbers. So we believe that the journey on recovery is another 3 to 4 months away, where we could start to sort of look at similar numbers around pre-COVID.
And then what explains this 20% margins in the month of March, sir?
Yeah, very strong footfalls at the cinemas. You know, still some of the cost cuts and the cost efficiency.
Controlled cost, very good footfalls. ATP was strong and so was SPH.
And would your exit SPH and ATP be higher than your company average SPH and ATP for the quarter? That's a fair understanding for the month of March?
Yes, absolutely.
Okay, great. Thanks. And all the best.
Thank you. The next question is on the line of Arpit Shah from Deep Research Capital. Please go ahead.
Hi, I just wanted to know what kind of revenues we were generating from the properties which you could acquire, the 9 properties.
Could you hear that?
Yeah. I'm answering that question. The Cineline properties which we closed on contributed approximately 2% of our revenues pre-pandemic, and a similar contribution to the earnings. Yeah.
2% of the revenue. And they have restarted the cinemas under a new brand, right?
Correct. That's right.
Okay. Thank you so much.
Thank you. The next question is from the line of Jinesh Joshi from Prabhudas Lilladher. Please go ahead.
Thanks for the opportunity. Sir, if you can talk a bit about your tie-up with Oma Cinemas, will we have to pay any kind of royalty for design know-how? And also, given the fact that these cinemas will have a pod concept, will it result in any kind of loss of teeth? And lastly, if you can also share what can be the capex per screen over here, will it be materially different than what we have for premium screens?
Wow. Is Pramod there or?
No, Pramod is, I don't think he's there on the call.
Okay. It's basically just the upfront cost as far as I know. We just concluded the deal with them. And I think ideally we won't want to look at a conversion at this stage. a conversion of an existing stream. It's very, very new and very on the layout really right now. We're just still evaluating various options in various places where we can introduce this concept. So we don't know for sure if there will be any seat losses or there will be, in fact, we'll be able to manage to get more seats or better seat efficiency, because we really haven't even started working on the layouts yet. But we would look at probably introducing this in a new multiplex and not in a retrofit. So in a retrofit you may have those worries of losing seats, but in a new project we will be able to accommodate the format and at the same time not lose any seats.
And the capex part and also the design part with respect to royalty and all.
Yeah, so let me answer that. In this case, this is an architectural concept. There is no long-term royalty payable. We'll be paying them for their services for designing the unique concept and putting that in place for each property level. So there is no long-term financial impact apart from exclusivity in being able to introduce that concept for the Indian market. And currently, I think it's a fairly early stage where we are going to identify a location and then develop a design concept which can be executed in that location.
It's also very early stage to even determine the capex per screen. As I said, we've only inked the deal not even 10 days ago.
Sure, sir. One last question from my side. I think we opened our first multiplex in Orissa some time back. So since we have debuted in this state, what steps are we taking in terms of branding, and any specific reason as to what took us so long to kind of enter this market? Was it lack of malls or any specific reason which you would like to highlight?
Raurkela was actually signed with a very established developer there, Forum Group, based out of Calcutta. And of course, as you know, from signing to opening takes a while any which way. And of course, as you said rightly, it was the rest of any retail development for the longest time. But the first and the best mall that came up in Raurkela, Forum Mall, we signed, and which invariably got delayed by 2 years because of the pandemic as well. So we had started work on that property 2 years ago before the lockdown. And then we restarted post-opening, both the mall and us restarted work, even they stopped. And obviously then we managed to complete it and open it in April. And it's showing good numbers initially. It's only been less than 4 weeks since we've opened it now. And it's showing some promising numbers. And we have another one coming up in Raurkela where we'll start work. We haven't started yet. We'll start work there as well in a couple of months' time.
Sir, one small clarification. This 8.7 crores of loss that we have reported from Sri Lankan operations, is this a non-cash charge or actual cash loss?
No, this is a non-cash charge. Part of our investments into our 100% subsidiary are structured in form of a foreign currency loan, and as a result of which we need to book a reinstatement loss on the loan as the currency depreciates. So this is a non-cash charge. This is only an accounting charge required.
Okay, sir. Thank you so much.
Thank you. The next question is from the line of Sanjesh Jain from ICICI Securities. Please go ahead.
Good afternoon, sir. Few questions from my side. First, on the ATP. So Inox has also reported the numbers. Just comparing the two companies, there is a divergence in the way how the ATPs have moved. The ATPs has improved for us, while the Inox it has declined on a sequential basis. Can you explain us or help us understand the ATP increase for us? Is that we have taken a price increase and Inox has moved with the similar pricing? What is the reason for the ATP? Because SPH, we are on the same trend as they are. So can you just help us understand the ATP? And if you have taken the price hike, what is the kind of price increase have you taken?
So let me correct you here. Even the SPH growth for PVR is much healthier than what the competition could manage. So on both the ends, be it ATP and SPH, I think we've been able to record slightly better numbers. But now coming to your question on ATP, ATP is actually a blended mix of what the operators manage with content, timing, premium versus non-premium, and the kind of content that plays out better within the circuit. So I think PVR could manage a healthy mix between the premium offering to a consumer and could maximize on that part of the game. And I think SPH as well, we've been consistently working on this piece and managed to record a good, healthy number. And we feel that this is here to now stay, and it'll only get better from here.
So what I understand is that we have not taken price increase, it's just a mix, and the mix is more towards premium. And going forward, this is the ATP we should be looking at, even for FY23.
Yes, the only thing, as I said, sometimes the kind of films that do well, the mix of tier 2 and tier 1 market mix, for us, South performed well. So each chain has its own strength, and the way they program content has a bearing on ATP, because ticket pricing is what you see, an average ticket price is a blended answer to what we've managed to do with ticket prices. And for us, that formula has kind of worked a little better.
Sure. Second question on the distribution margin. Again, there is a divergence trend between the two players. For us, on a sequential basis, the margin has declined, while for the competition it has increased, while we have done better on the ETP side. But the flow-through has been slightly inferior for us. What explains that?
So, we would not like to comment on the comparison because this is all sensitive data and information that we would not be comfortable sharing on the public platform. I would only say that in Q4, because Jan and Feb were disrupted months where cinemas were open but content was not really coming, new content I mean, very difficult to analyze it the way and the manner in which you're looking at it. I think if you wait for another quarter, look at April, May, June period, which is Q1 of the current financial year, you will get a better sense of where the film hire and the other comparative variables are moving.
Yes, sir. But just to understand for next year, for PVR, how should we look at the distribution margin? Should it settle to the historic level, pre-COVID levels? Will that be a fair assumption, or for a time being we will accommodate, as we said earlier, the producers because they have waited a lot for the movie releases? How should we look at the distribution margin for FY23?
So the accommodation strategy has, it has stopped in March. We are back to historic levels as far as the sharing percentage goes. The only moving part now is because we have variable sharing percentages in different languages. What I mean is in Telugu, Tamil, Malayalam, Hindi, Punjabi, Hollywood films, we have a different sharing arrangement with the distributors. So depending on which language performs better, the blended film hire percentage could vary. But the sharing percentage, we are back to historic levels.
Yeah, back to historic levels. The next one is the shows per day. In the April, are we back to that 4.7, 4.8 shows per day, and the entire inventory is available now with the normalization?
Yes, we are back to our normal average shows, and I think the average is slightly higher than 4.7. It's 5 plus.
Okay.
And except Jammu, where we have a capacity restriction in India, no other state has any capacity restriction. And of course, in Sri Lanka, there is a small restriction of capacity. We are permitted to sell 75%. So apart from that, within a chain, there is no restriction in any other state or any other territory.
Fair enough, sir. On the distribution business, we did mention in the previous call that we will be stepping up on that business side, on the film distribution. How are we looking the film distribution business for FY23?
Nitin, you want to comment on this?
This is the PVR Pictures part of the business you're talking
yes,
about?
PVR Pictures part. Right, right.
This is PVR Pictures, Ms. Kamal. Do you want to talk about it?
Yeah. So, we continue to build on our distribution business. It saw a sharp recovery in financial year 22. We were fortunate to have a couple of films releasing, couple of big films which came out theatrically. We were able to move a lot of our Hollywood foreign language inventory to various streaming platforms and television stations. All of that resulted in a very sharp recovery in our distribution business. We were pretty much back to where we were pre-COVID. I mean, we could have done better if there was no COVID impact in the beginning of calendar year 21. We could have done better in terms of top line and most likely bottom line. But I think we made a very sharp recovery given that exhibition was still struggling. We are extremely buoyant on distribution business. We are getting many opportunities. Fortunately, PVR has a very strong brand equity amongst all content partners. We are seen as a very solid distribution service platform. We get many opportunities. So it's our endeavor to scale up this business manyfold, and you would see a lot of action, a lot of steps in that direction. But we would speak more about it as we move forward.
Thank you. Mr. Jain, could you join the queue for any follow-up as we have several participants waiting for their question. Also, participants are requested to limit their question to 2 per participant. If time permits, you may join the queue for any follow-up. Our next question is from the line of Vipul Garg from Kotak Mahindra. Please go ahead.
Hello, am I audible?
Yes,
Yes, you are.
Yes, you are right.
Yes, sir. Actually, you told that you would be going for a CapEx of about 120-125 screens during FY23. So what would be the CapEx amount for same?
Yeah, our annual CapEx outlook this year will be between 350 to 400 crores on new build screens, plus also, maintenance CapEx on existing screens. So we are looking at annual outlook of anything between 350 to 400 crores this year.
And what would be the debt levels at present? About 1,400 odd crores.
Gross debt is about 1,500 crores. Net debt is about 900 crores.
Okay, and would you be able to share the debt and cash numbers for INOX also or not?
I can't comment on INOX numbers as of now.
Okay, fine. Thanks.
They're in public domain. You can refer to their website.
Okay. Thanks.
Thank you. The next question is from the line of Harit Kapoor from Investec. Please go ahead.
Yeah, hi, good evening. So I just wanted to check on 2 things. One was, during the pre-COVID period, you had made certain structural cost, saving measures across the OPEX line. At that point, I think you mentioned that ex-rent, you are looking at a like-to-like cost reduction of about 10% across all lines. Just wanted to know in the current context, where, the inflationary environment would probably hit even your employee cost line and, you would have to ramp up costs. Does that, like-to-like 10% reduction kind of, number still stand, or it would be lower, in a fully operational business?
A fairly valid point you've said, and if you refer to slide 18 of our presentation, which basically shows an outlook of how we've been managing our costs so far. I think even in Q4, if you look at, let's start with the people cost. Our average run rate of cost in FY20 on people cost was roughly 100 crores a quarter, which in Q4 this year is 81 crores, is still 20% lower. With our headcount, low as compared to pre-pandemic, and we are reasonably confident that we will be able to operate next year on a same store level, a lower headcount than what we were operating in pre-pandemic. However, as you rightly said, there is a wage inflation already in play. I think we've already seen up to now almost a 11 to 12% hike in average cost as we compare to FY20 on account of minimum wages and cost inflation. And there is likely to be even further inflation this year as the business bounces back. We've not given significant increments, etc., to the team. So some bit of inflation is going to play out for sure. But I think we think that some of it will get recouped by the higher realizations that we are doing. But our cost should still be closer to what we were doing in FY20, in FY23. We may not be possible to get full 10% savings over FY20 given the inflation, but we still think that we'll be able to keep this cost at FY20 or below levels even in FY23.
The higher screen count. Right. Thanks for that, Nitin. The second question was on the screen addition. So this pickup from 80 odd screens to about 125 screens. Is that just a function of pent up assets at the developers end, which probably you were not taking or were not getting completed due to COVID, and this kind of come in one shot? Is that the way to kind of read it?
Yes, precisely. I think a lot of the development themselves also stuck due to lockdowns and COVID, and the malls weren't ready, but now the malls are ready, and therefore we're taking the handover and start work on them. And also we have a lot of large format ones here, which is accelerating the screen count. We have 8 screens to 10 screens to even a 12 screen complex coming up. Some what we call big complexes. So those are actually adding up to the number of screen openings for the year.
And just to follow up on that screen addition part, it seems like a larger share in South India for this year. So is this that coincidental in terms of what properties are coming, or is it more of a planned thought process, at least for FY23?
No, I think we're quite spread all pretty evenly all over the place. I think the ones in South India, maybe a few they're just more large formats because, as I said, more screens, 8 to 10 to 12 screens, because of the acceptance of multiple language films. Otherwise, we have Gujarat, Gurgaon, Pune, even the East India, again, Rourkela. It's pretty well spread out throughout the country.
Yeah, that's it for me. Thanks and all the best.
Thanks.
Thank you. The next question is from the line of Girish Pai from Nirmal Bang Equities. Please go ahead.
Yeah, thank you for the opportunity. Just want to discuss potential CCI involvement in the merger deal. Is there a timeline within which CCI has to raise any objections, if any, post which it becomes kind of a time-barred situation? That's point number one. Second, if there is CCI involvement and there is a divestment of screens that is required from your side, is there a certain minimum threshold you're looking at, or beyond which you would probably want to kind of go ahead with the deal? Those are 2 questions I want to ask you.
So, please let me respond to your second question first. The second question is quite hypothetical, and we haven't even thought about anything like that. So, we would refrain from commenting. On the first point, until what time, CCI can intervene, I am not aware of any specific, guideline, but our understanding is mergers are typically fall under the merger control guidelines, and effectively, if you need an approval, you need to apply to them and seek an approval. If you don't need an approval, you don't need to file with them. So to be honest, I'm not aware of any timelines, but if I'm guessing the stock exchanges and SEBI approval, once it's in place, will be the basis for us to go ahead and file in the courts.
Just one more question regarding the CCI thing. You had a experience with DT Cinema situation where you had to divest 7 screens out of 39 screens, of which one was in a property in Saket. What, in your opinion, determined that particular situation where CCI said that you need to divest, 6 screens in Saket? Is it a micro market, monopolistic situation that you saw? That it saw?
The starting point of that question is whether a transaction is notifiable or not notifiable. And in the case of that transaction, when we are acquiring that business, that transaction was notifiable. In the present case, when we are doing this transaction is not notifiable according to law. So both the situations are not comparable.
Thank you very much.
Thank you. The next question is from the line of Jay Kumar Doshi from Kotak. Please go ahead.
Hi, thanks for the opportunity. First off, bookkeeping question on theatrical window. Now that the business is normalized, is there a understanding with producers in the Bollywood to move back to, let's say, 8 weeks of theatrical windows?
Yes, we will be returning to the erstwhile 8-week window by end of July.
Perfect, thank you. Second,
this is for Hindi films. For different language films, it will be a different arrangement. But for Hindi films, which is our staple diet, we will revert to 8 weeks at the end of July.
Perfect, thank you. Second is, I was a bit surprised when you sort of mentioned that advertising revenues would take 3 to 4 months to recover. I was hoping that the way April has shaped up from a box office perspective, ad revenues would have largely recovered. So, what is the challenge you are facing on the ground, and if you could elaborate a little bit on it? And does it mean that FY23 ad revenues could be lower than FY20 or at best match FY20 levels?
First of all, yes, it is most expected that actually advertising revenues will be lower than the pre-COVID level, number one. Number two, now coming to the question of why it's taking time, because you need to understand cinema as a medium is the fourth or the fifth priority for a media planner. So technically, we've been off radar for close to about 30 odd months, and it will take time before planners and typically a plan gets made about 3 or 4 months prior to a big launch. And that's where most of our bulk of our earnings happen. So we are back on the radar. We got a fairly decent recovery in March. But having said that, we are waiting for some big blockbusters. The good news around KGF, RRR, Gangubai is only helping matters. And now with Doctor Strange doing well at the box office, we still believe it's a few weeks away, but very, very confident that within about 3 to 4 months we should be back on track.
What is your mix between local advertisers and slightly larger, more organized players?
So technically the split is about 60-40. We still cater 40% to retail and small businesses. 60% is largely on big businesses, and which is garnered through agencies and the corporate offices.
Are you seeing a better recovery in either of the two, or or it's broadly similar?
Actually, yes. The retail is much better. they're warmed up to, because their stores are in the mall. They can already see a huge amount of recovery. They can feel the pulse a lot better. So that retail recovery in specifically in South is very, very good. In fact, if you look at market, South has done well and has recovered fairly well. North as a market is second in line, but it's actually the West region which has a bulk of contribution to make is taking a little more time, because there you have the maximum corporate business flowing in, and that's taking some bit of time.
Understood. Thank you so much.
Thank you. The next question is on the line of Mayank Babla from Dalal & Broacha. Please go ahead.
Hi, thank you for taking my question. I have two questions. My first one is particularly about footfalls. So I needed your help in understanding that, despite having a larger screen base compared to our competitor and being more diversified, is there any other specific reason why there was a hit in footfalls this quarter compared to last quarter?
Can you repeat your question? The last part, not very clear.
Yeah. So my question was, why were the footfalls marginally down quarter-on-quarter basis?
You mean Q4 of financial year 22 as compared to Q3?
Yes.
Because Jan and Feb we didn't have releases, whereas in Q3 we started getting films in October, and we had films right till the end of December. So there were more productive weeks in Q3 as compared to Q4. Nitin, you want to add something? Maybe I'm missing some point.
No, we covered that. With Q4, basically the Omicron wave hit, third wave.
Yes.
End of December to all the way to Jan end, and since capacity restrictions were imposed in Delhi and Haryana, which are of course a very big market for Hindi movies, no new films got released till the third week of February. So all of Jan and most of February, no new movies got released. And movies started getting released only after the restrictions were lifted, such as Gangubai and all. And then that week, 10 days of February and full March is where we actually had recovered and genuine footfalls.
Right. So thank you for that. And my second question was regarding does the promoter have any pledge of around 6.3%?
Hello?
Yes, there is a pledge. Yes, there is a pledge of securities. They have taken some short-term borrowings. Yes, there is a small pledge of shares.
So this was in the March quarter itself, is it? Or it was before this quarter?
This was in the March quarter, yes.
Okay, sir. Okay. That's all. That is my only question. Thank you so much and best of luck.
Thank you. The next question is from the line of Arun Prasad from Spark Capital. Please go ahead. Arun, your line is unmuted. Please use the handset mode and proceed.
Hope I am audible now.
Yes.
Yeah. So my first question is on the screen opening, which you have indicated as around 125 about in the coming years annually. So question is this restricted because of the fact that you want to open only up to the internal accruals, or is it more because of the mall developer handing over the property?
No, this is because, this is the list of pipeline of screens that we are executing. We are executing a little more, to be honest. But we are because sometimes the screens get delayed on account of developers' execution as well. So the number of screens under fit out will be more than what you see, what will end up opening. But yeah, we hope that these many will definitely open during the course of the year.
So in the medium term, would the mall pipeline will be the constraint, or do you see any issue in that?
No, we don't see any constraint in that. We see active mall activity on the ground. A lot of new screens, moving towards execution. And, we will also be moving to a lot of new cities, in the next few years, adding a lot of tier 2 and tier 3 cities, which are beginning to see development of retail infrastructure now. And that will also be a big focus area for us.
Okay, that's clear. My second question is on the cost of debt. Your current cost of debt is north of around 11%, which is at around 400-500 bits above the G6. Do you see with the balance sheet strengthening, do you see this spread coming down, and what extent can we expect this reduction?
Yeah, our average cost of debt, just to clarify, is close to 9%. I don't know where you got the 11% number from. If you are looking at the interest cost, that is
Sorry, ladies and gentlemen, it seems that we have lost the line for the speaker. We would request all participants to please stay connected. Ladies and gentlemen, we have the line for the management reconnected. So what do you?
Sorry, I was just answering the previous question. Just to clarify, our average cost of debt is not 11%, but it is close to 9%. The overall interest cost charges that you see in the P&L also includes, bank charges, etc., that are applicable on the credit card usage that we pay to the banks, and also has an impact of Ind AS adjustments which are pertaining to front accounting of convenience fee income, etc. So which is a non-cash charge. So our average cost of the debt is close to 9%. Also, as during the year, like I said, we intend to fund all our growth through internal accruals and liquidity that we have in hand. And if there is any free cash flow generation from the earnings, that will go on to reduce leverage. I think our leverage is ideally peaked now, and as we get into earnings and cash flow generation from the business, hopefully this should start coming down from these levels.
So do you see the cost of debt coming further down from this level?
So we are in a high interest rate environment now as we enter this year. It's difficult to say. If there is any refinancing opportunity, clearly it will happen at a lower cost than what we borrowed during the pandemic, for sure. But given the increase in interest rate during the year and the impact of it in its existing portfolio, I don't see any material changes, in our average interest cost from here.
Okay, thank you very much. Thanks.
Arun, is the question answered?
Yes.
All right, thank you. We will take the next question from the line of Jay Kumar Doshi from Kotak. Please go ahead.
Hey, hi. Thanks for the follow-up. Just a quick question. When does your convenience fee contract with BookMyShow and Paytm expire? And are there any discussions around renewal of the same?
Both the contracts were set to expire in 2021, but because cinemas were shut, the contracts were extended, and they will expire in 2023 calendar year, different dates. As you know, SPI, which is now merged into PVR, they also had erstwhile pre-existing contracts prior to the merger. So those dates will also fall sometime towards the end of 2022-23. As far as on the discussion front, I would not like to get into these details.
Essentially, it's still 2-3 quarters away, 3 to 4 quarters away.
It is still a few quarters away.
That's it from my side. Thanks again.
Thank you. Ladies and gentlemen, due to time constraints, that would be our last question for today. I now hand the conference over to Mr. Nitin Sood for closing comments. Thank you, and over to you, sir.
I would like to thank everyone for taking our time for our call. And if we've not been able to answer any questions during the call, feel free to reach out to me or my colleague Saurabh, and we'll be able to individually do one-on-one call with you guys. Thanks once again.
Thank you very much. Ladies and gentlemen, on behalf of Axis Capital Limited, that concludes this conference. Thank you all for joining us, and you may now disconnect your lines.